Good afternoon, everyone, and welcome to the very first FundSmart webinar series powered by FirstMetroSec. My name is Cara, Tomada, and I, including the rest of the FirstMetroSec team, hope you find this webinar beneficial for whatever purpose it may serve. For our pilot episode, we have decided to team up with one of our FundSmart partners, ATR Asset Management or ATRAM. For those wondering what exactly is FundSmart, it is First Metro Securities' online mutual funds platform, which allows you to subscribe to over 40 peso and dollar-denominated mutual funds from the six leading fund houses in the country. One of them is, of course, ATRAM. After this webinar, just log on to your First MetroSec account, and on the upper right corner, you can see the FundSmart tab. Our speaker for this afternoon is Miguel Liboro, ATRAM's Fixed Income Portfolio Manager, with his topic, Fixed Income 101. People talk about stocks, mutual funds, but today we will take a hand on fixed income, just to give you more flavor in the different investment options available to fit your needs and lifestyle. Just a brief background on Miguel, he has 8 years of experience in the field of treasury trading, and asset management, and has been with the firm for more than 5 years. He completed the Bankers Association of the Philippines Treasury Certification Program and was awarded one of the most astute investors in Asian currency bonds by the Asset Magazine for the years 2015 to 2017. And before we hand over our mic to the speaker, we would like to take this moment to remind everyone that you can send in your questions at any time through the side panel provided if you are on your computers, or swipe left if you're accessing this webinar through the app on your mobile phones. We will be answering them later in the Q&A portion of this webinar. You can also download the latest ATRAM Peso Fun Fact Sheets through the handout section of the side panel to give you a better picture of our topic this afternoon. And again, ATRAM funds are available to you online through FundSmart. So while we wait for everyone to settle in, may we invite those tuning in right now to participate in a quick Getting to Know You poll. Just keep your webinar screens open to answer the poll. First question up, are you aware of FundSmart? You may answer the question now. Thank you for answering. Now we know that 60% are aware of FundSmart. For the remaining 40% unaware, hopefully this webinar is the perfect opportunity for you to explore the platform. Second question now up. Are you invested in any FundSmart funds? Please select one answer. Thank you for answering. Now we know that 32% are investing in FundSmart. Our third question now up. Which is your primary source of investment? Please select one, stocks, mutual funds, real estate, savings account, or others. Thanks for sending in your answers. We can see that 13% of our viewers are investing in mutual funds. And our last question, are you investing in any ATRAM fund through FundSmart? Thanks, everyone. Now we are aware that 13% are investing in ATRAM through FundSmart. And for everyone else, hopefully this webinar will encourage you to get to know the funds and invest in them. We also have exciting giveaways for you today. So we hope you guys stick around till the very end and be sure to join our growing community on Facebook. If you're not yet a member, just type in www.facebook.com/groups/FirstMetroSec. Or you can also search First Metro Securities or First MetroSec official community on Facebook. We would also like to invite you to like and follow the official Facebook page of ATR Asset Management to get their latest updates. Head over to www.facebook.com/ATR Asset Management. And now, without further ado, our main guy for this afternoon, ATRAM's Fixed Income Portfolio Manager, Mr. Miguel Liboro. Miguel?
Hi, afternoon. Hi, afternoon, everybody. I'm Miguel Liboro. I'm a portfolio manager for ATRAM. And hopefully after today, we can bring up the number of people invested in the fund from that poll. So right now, let's move to the agenda. Today, we'll be talking about some investment basics and why fixed income may be the type of investment that makes sense for you, depending on your own investment needs and expectations. Afterwards, we'll discuss our view on the current market conditions and why we feel that it could be a good time to invest in fixed income, as well as some recommendations on how to go about this. So people invest for a variety of different reasons, and we've listed some examples of those over here. Now, whether or not you see your own reasons for wanting to invest on this list, what is certain is that those reasons are specific to you and that there's no such thing as a one-size-fits-all type of solution. Your investment decision will be shaped by your investment objective, your investment time horizon, and your risk appetite. Now let's talk a little bit about risk. This graph shows where some asset classes fall into from a risk to reward standpoint. You'll notice that this graph is upward sloping. This means that the asset classes which have the possibility of generating higher returns also come with higher risks. A perfect example of the saying, no risk, no reward. Now, moving from left to right, we have the less volatile asset classes, such as bank time deposits and fixed income securities. And then moving towards the right, we have the more volatile asset classes, such as equities, and the more illiquid asset classes, such as jewelry and real estate, the more tangibles. As you can see, there are a wide variety of different investment vehicles, each with their own specific nuances. Today, we'll be focusing on fixed income. Now, what is fixed income? By definition, a fixed income asset is a type of investment that delivers a predictable and, in most cases, predetermined return at a regular frequency. Now, money market instruments such as time deposits fall into this category, but the widest category would be bond securities. Now, at its core, a fixed income security is essentially debt. When we purchase these securities, we, investors, act as creditors and lend money to the issuer of the bond, whether they're a sovereign nation, such as the Philippine government, or a private corporation. We're compensated for this through the coupon payments we receive from the bond security. These payments serve as our interest income and the return on our investment. Now on the screen are some reasons which make the argument for investing in fixed income assets. Fixed income assets allow for a more deliberate approach to investing. Assuming that you held the security until maturity, you'd be able to plan your financial decisions around this timeline of those predetermined cash flows, removing the element of surprise in most cases. For an investor with known liquidity requirements, this predictability ensures that they can structure their portfolio in order to service these requirements by only investing in securities that you know for a fact will be maturing prior to when you need the cash. Now, fixed income is typically less volatile as an asset class than equities and is used by most investors to anchor their portfolios. Many investors value the stability that this offers, and the fixed income market is actually the second largest financial market in the world, smaller only than the currency market. Now, this table has some examples of fixed income securities. Within fixed income as an asset class, there's a wide variety of investment instruments. The table below highlights two types: government securities and corporate securities. On the left-hand side are government securities. these are considered risk-free. This is because the risk of the government defaulting or not paying on one of its bonds is mitigated by the fact that theoretically they have the option to either raise taxes or print more money in order to service these debt payments. The four types listed on the left are the major classifications or types of government securities that we have in the Philippines. All of these are guaranteed by the Republic of the Philippines and are actively traded on a daily basis throughout the week. Now, just going into a little bit more detail, you can see some of the major characteristics of each of these four types of securities. On the right-hand side are some examples of corporate bonds. I'm sure that some, if not all, the issuers listed here will be familiar. These are companies that provide goods and services that we encounter in our day-to-day lives. And issuing bonds is one of the ways that they raise funding for their operations and expansionary activities. Corporate bonds are typically higher yielding than government securities. And the reason for this is that they require a credit spread. No matter how good a private company is, it will always carry some degree of risk because it's not considered risk-free like a government security. The extra yield that we, as investors, demand for this risk is what we call the credit spread. Now, stronger, more well-known companies will typically have a lower credit spread because they're perceived to have a lower risk of defaulting on their debt securities. On the other hand, unfamiliar companies or those viewed as less reliable will typically have a higher credit spread in order to compensate investors for that risk and make their own bond offerings more attractive. Over here, we have an example of how the cash flow works on a bond security. Assuming that you purchased a 3-year government bond with a 5% coupon, which is its interest rate, that paid out at a semi-annual frequency. So in moving to the table previously, you would consider this a government security, which was an FXTN or fixed rate treasury note. Now, simplistically, if you invested 100,000 at the issuance of the bond, you would then receive each year the 5% coupon or interest rate. Now, 5% of that 100,000 is 5,000. And because the coupon is paid out semi-annually, you would receive that 5% coupon in 2 tranches each year, which is illustrated in the example in front. At the end of the period, or at what we call the maturity of the bond, you would then receive the final coupon payment as well as the initial principal that you had invested. So for this particular bond, assuming that you had bought it at issuance at par and held it to maturity 3 years later, you would get 5% each year plus your principal upon maturity. In this case, that would mean a return of 15% or 5% for each year that you held the 3-year bond. So we've talked a little bit about how bonds are structured, how you can make money from them, and what makes them attractive with respect to their predictability and stability. So now we'd like to highlight some of the risks. Now, this is mostly a definition of terms. Credit risk is something that we went into earlier. Now, the credit risk that you have is based on the probability of default, or how likely is it that the bond that you purchased, how likely is it that their issuer will be unable to pay their interest payments and in so causing a default. Now, counterparty risk is more to do with who you are dealing with, not specifically the issuer of the bond, but who you are buying or selling the bond to. Now, this is something mostly run into on the institutional space because as retail investors, your counterparty is either the bank or the fund that you're invested in. The next is liquidity risk. It's the risk that you, as the investor, will not be able to liquidate or sell your asset for cash when you need it. Now, in the government bond space, liquidity risk is actually quite low because it's an actively traded market. But on the corporate bond space, liquidity is somewhat of a concern because the corporate bond market is not as actively traded. the chances that you are going to be able to exit or liquidate your position at any given point in time varies depending on the particular corporate bond that you're holding. Interest rate risk is something that all bond investors have to be keenly aware of, because this is the risk that the value of your securities will either rise or fall depending on how interest rates move. As interest rates move up, price moves down, because price and yield have an inverse relationship when it comes to bonds. Sovereign risk is, as I mentioned earlier, it's the risk that a government will not be able to pay its debt obligations. But theoretically, because the government can either levy taxes or print more money, sovereign risk is largely discounted. Currency risk is if you're dealing with a multi-currency portfolio, the risk that losses arising from the exposure to the foreign currency will affect your bottom line. So as a Filipino investor, typically you would be thinking or earning in pesos. By being invested in a foreign currency, you are subject to the fluctuations of the interest rate, of the exchange rate. And finally, reinvestment risk. If you bought a 1-year bond at 6%, you would have no guarantee that you would be able to reinvest that a year from now at the same rate. Because depending on prevailing market conditions, rates would either move up, in which case it would benefit you to reinvest at a higher rate at that point, or move lower, which means that you will now no longer be able to get that initial 6% that you had last year. So we've talked a little bit about bond basics, about how they're structured, about some of the risks inherent in investing in fixed income securities. Now we'd like to talk about our view for the year and why we feel that it's a good opportunity to invest in fixed income right now. So let's begin with a review of last year. Now, anybody that was invested in fixed income could tell that last year was a particularly challenging year, and that's because interest rates were on the way up. In fact, even those that weren't invested in fixed income would probably have an idea because inflation shot up massively. We moved from an inflation of 2.9% at the beginning of 2018 to as high as 6.7% by October. And inflation is one of the key drivers behind the movements of interest rates. As inflation moved at that pace, interest rates in the broad market also moved higher in response. In an attempt to arrest the upward movement in inflation, the Bangko Sentral ng Pilipinas raised short-term interest rates. Monetary policy is one of the more effective tools in controlling the inflation, and the Bangko Sentral ng Pilipinas, or BSP, has an inflation targeting mandate. Before inflation hit their high at 6.7 in October, interest rates moved from the end of 2017 to their peak in October 2018 as much as 3% across, which is a very significant move. Now, the key drivers behind such a significant surge were the upward shock in inflation that we've already mentioned, and the initial loss of market confidence, because as inflation moved higher and higher, investors were unsure whether or not the BSP could arrest that move in time or whether inflation would continue to move even higher. On the back of that, we also had our exchange rate, which was depreciating at a rapid rate earlier in the year. We saw the peso move from 50 pesos at the beginning of the year, at the beginning of 2018 or the end of 2017, to as high as 54.3 by June. All these factors taken in together are what caused the yield curves on the right in the graph to move the way they did. A 3% move from 2017 to their highs in October, and then a small gradual move lower as inflation began to moderate, which is the green line that you see there, where we ended 2018, around 1% below the highs of the year, but still significantly higher than where we ended 2017. So what do we think about 2019? Rising inflation, rate hikes from the BSP, sharp PHP depreciation, all these risks have begun to dissipate. So a very challenging 2018 has actually served to set the stage for what has already been a solid start to 2019, and one that we think will continue to be a good year for Philippine fixed income. In fact, what we're seeing now is a bit of a rare phenomenon. If you look at the blue yield curve at the lower end of the graph, you'll see something that is quite uncommon. Now, a yield curve is typically upward sloping. That means that the, the longer the maturity of the bond, typically the higher the yield that you would get for that bond. That's because of two things. One is the first is term premium. It's the concept that the longer that you are invested in a security, the higher that you should be paid for that. And that's because of the uncertainty involved in holding that fixed income investment. What you're seeing now is actually an inversion of the yield curve. Because as you can see over there, the 1-year portion of the yield curve is yielding at around just below 6%, whereas longer tenured securities, such as the 5-year, the 7-year, the 10-year, all the way to around the 12 to 14-year portion of the curve, are all trading, or were all trading as recently as 2 weeks ago at around the 5.5% level. Now, that doesn't seem to make a lot of sense, because if you could buy a 1-year bill for 6%, why would you buy a longer security at 5.5%? And the reason for that was because with inflation having moved from a high of 6.7 in October to as low as 3.3% in March this year, investors are now thinking that inflation will continue to move lower throughout the year. And given that view, it benefits an investor more to have a longer tenor or higher duration security. Duration is the measure of the interest rate is the measure of sensitivity of a bond to a move in interest rates. Now, the higher the duration of a security, the higher the risk. Because as interest rates move up, which is what we saw last year, then higher duration or longer tenor securities are more adversely affected. But conversely, as yields move lower, higher duration securities or longer tenor securities benefit more and are subject to a greater degree of price appreciation. And because investors now believe that inflation will continue to move lower and average 2019 at around the 3% level, there's a greater demand for these longer tenor, higher duration securities. That has caused this temporary inversion of the yield curve. In addition to that, because of the lower inflation expectations, there has been broad speculation amongst institutional investors that the BSP is poised to cut the reserve requirement rate. Now, we think that they may cut as soon as their policy meeting this coming May, and depending on whether or not inflation continues to move lower, there may be potentially scope for a second cut towards the end of the year. Similarly, after last year, where the BSP raised rates by a total of 1.75% on their short end policy rate, from 3% to 4.75%, where it is now, we think that there's an increasing probability that they will begin to cut rates lower. If inflation continues to decelerate at its current pace, we think that the BSP may cut rates by 25 basis points from 4.75 to 4.5% sometime in the second half of the year. And depending on how quickly inflation continues to move, there may be scope for a second cut towards the end of the year. But right now, yields have begun to consolidate in the short term. Going back to the graph, as you can see, there has been already a significant move lower in yields from the end of 2018 to the end of March. And now we think that it's poised for some consolidation or for yields to kind of gravitate within a very tight trading range. So what do we think moving forward? Right now, we think that the 1 year and especially the 5 year portions of the curve offer value. For our own funds and portfolios, we continue to manage duration actively. Whenever we think that there are tactical opportunities to increase duration or interest rate risk, we intend to buy on the 5 year and longer, and then take profit on those positions as those views play out, moving back into the relative safety of the 1 year, which is still trading at around 6%. Active management will remain key in this ever-shifting environment. We also intend to maintain our flexibility by focusing only on the liquid securities. At this point in time, there are over 70 outstanding government securities. But of those 70, only 8 to 10 trade with any semblance of day-to-day liquidity. And that liquidity tends to transfer quite quickly. Knowing which bonds to invest in and have that type of liquidity, which allow you the flexibility to move in and out, will help determine strategy. Because it can be very difficult to be stuck in a bond that is illiquid, especially once interest rates begin to move higher. Now, apart from that, what we've also been looking at doing from the latter part of last year has been to enhance portfolio yield via corporate bond issuances. Corporate bonds, as we mentioned, do tend to be quite illiquid, but at times the credit spread offered by these bonds is more than enough to compensate for that lack of liquidity. But you always have to be careful on which corporates you take a chance on, because not all companies are equal and not all companies have the same credit profile. Now, with that in mind, we'd like to make a couple of recommendations on where you may potentially invest in the fixed income space. The first thing I'd like to discuss is our ATRAM corporate bond fund. As I mentioned earlier, one of the key risks in corporate bond space is credit risk. Now, the corporate bond market is actually the largest that it's ever been locally. At the end of 2017, the corporate bond market was, in aggregate, had around 800 billion worth of outstanding bonds. There was a record amount of issuances last year that took that number to around 1.1 trillion. And we're hearing that there are a lot more corporates looking to issue in the pipeline for 2019 and 2020. Now, what are the hurdles though investing in corporate bonds? Typically, corporate bonds require a larger capital outlay. Unlike government securities, which you can go to a bank and buy for a small amount, corporate bonds typically have much higher minimum lot requirements. On average nowadays, as a retail investor, it's very difficult to participate in a corporate bond issuance unless you put in 500,000 pesos or more. This also leads to what we call concentration risk. It means that bulk of your portfolio is stuck in just one issuance, and especially in a in a market as illiquid as corporate bonds, that also opens you to liquidity risk. Because even if you assume that you're going to hold the bond to maturity, who knows what can happen? And if at any point in time you needed to liquidate that position, at worst you may not have a buyer to buy it, and maybe at best you would probably have to sell it at a lower value than what it was actually worth, just because of that lack of liquidity. Now, investing in the corporate bond fund addresses all of those issues. It addresses your concentration risk issue because the fund is extremely diversified. It's invested in over 20 separate issuances and more than 15 separate issuers, all of whom we have done the credit work on and, and have gone through our robust credit review system. Because as I mentioned earlier, yield is not the only consideration when choosing corporate bonds. You have to be aware of exactly what you're getting into. And our process not only ensures that we're investing in names that we believe will be able to pay us back, but that we are also being compensated fairly for the risk we're taking. Because not all companies deserve to issue at the same credit spread. The next is liquidity. I highlighted that liquidity could be a consideration when buying corporate bonds. But the corporate bond fund has a regulatory 5% cash buffer at any given time. This means that if you needed to redeem, you wouldn't be forced to unwind or liquidate your bond at whatever the market price was, which is what you would have had to do if you'd held a direct security. The fund has standing liquidity provisions which allow its investors to redeem with little to no price slippage. Also, it's dividend paying. Although the fund is open-ended and constantly looking for opportunities to reinvest as bonds mature, investors get the benefit of that yield through a dividend payout, not unlike a corporate bond coupon. And finally, it's actively managed. The corporate bond fund is invested in purely Philippine corporates. And we look at it from a bottom-up approach. We look at each of these companies specifically to determine which of these are the best credits, have the soundest fundamentals, and have the largest probability of paying us back. And then depending on what yields are being offered in the market, we make an assessment on which of these credits belong in the portfolio. So if you're looking for a medium to long-term investment vehicle with little to no volatility and that you don't want to worry about by checking the news all the time to wonder whether you're up or down, then the corporate bond fund might be a good option. Another one we'd like to discuss is our ATRAM Total Return Dollar Bond Fund. Now, what does total return mean? I explained earlier how fixed income securities can make money by holding them to maturity and collecting those income payments. Now, that's called an income generation strategy. But a total return strategy marries that income generation strategy with an actively traded capital appreciation mandate. So what that means is part of the portfolio is there to accrue and generate interest and make sure that the fund holdings are not very volatile, but a part of the portfolio is also there to take more active risks based on short-term factors and whether or not we fund managers see whether there's an opportunity for price appreciation based on short-term technical or fundamental factors. A total return strategy combines these two approaches in order to try and deliver both an income strategy and a capital appreciation strategy. Now, the Total Return Dollar Bond Fund is a global fixed income fund. You're invested in dollar-denominated sovereign names, dollar-denominated Philippine corporate bonds, but also right now investment-grade Asian corporates and Asian sovereigns. Typically, these require high capital outlays in order to invest in them. By investing in the Total Return Dollar Bond Fund, you're able to participate in the Asian growth story via the pooled fund and for as low as $1,000. Sorry, $250. You'll see there that one of the points is also the income through credit, duration, and currency. Now, duration is what I described as the trading strategy. The credit is there based on the credit spread or income and on the currency, depending on whether or not you have a view on the dollar. And right now, our view is actually a gradual depreciation of the peso towards the 54 to 54 and a half level. You can also make the additional currency gain on the appreciation of the dollar because this is a dollar denominated fund.
Thank you, Miguel. What an exciting way to kick off the FundSmart webinar series. My three main takeaways are: firstly, there are many avenues to invest in. It's not just deposits, stocks, real estate. There's also investing in the fixed income space. And ATRAM has the perfect options for this, such as the ATRAM Corporate Bond Fund and the ATRAM Total Return Dollar Bond Fund. Secondly, investment instruments in fixed income securities include government bonds, which are risk-free, or holding corporate bonds, which are typically higher yielding. And lastly, it is definitely a good idea to invest in fixed income securities this year because the risks that battered the market in 2018, including rising inflation, rate hikes, and the sharp depreciation of the Philippine peso, have started to wane. For everyone tuning in, what are your takeaways? Send them in the chat box in the side panel provided so everyone can see and learn from each other. Now, before we proceed with our Q&A, we would like to remind everyone who is not yet a member to join our growing Facebook community. You can simply type in www.facebook.com/groups/FirstMetroSec or search First Metro Securities or FirstMetroSec official community on Facebook. Don't also forget to like ATR Asset Management on Facebook to be updated. Head over to www.facebook.com/ATR Asset Management. Now on to our Q&A. We have quite a lot of questions sent in through our chat box. So if you have any questions for Miguel, just type in your questions via the side panel provided. If you're on your computers, or swipe left if you are accessing this webinar through the app on your mobile phones. Now, first question, we have one from Mr. Dustin Ang. How did you Total Return Peso Bond Fund, how did your Total Return Peso Bond Fund perform in 2018 given that inflation was so high?
Hi, first of all, thanks for the question. We were actually able to maintain the fund performance at almost flat, which was actually a challenge given last year. Although inflation wasn't moving as high in the US as it was here, what you had was a very aggressive US Federal Reserve. What they did was they hiked rates 3 times last year by 75 basis points in aggregate, causing yields on US Treasuries to move significantly higher. Now, as I mentioned earlier, duration is one of your considerations, and I believe most bond portfolios may have been loaded in duration at the time, which caused them to underperform because as rates were moving higher, the valuation of their securities was going lower. Because we had held the view that the Fed would be aggressive in moving rates higher, we were more heavily positioned on the short end and on what we call the belly, or the 3 to 5 year portion of the yield curve. Now, this means that although we were also hit by the move higher in interest rates, the yield or income that we were generating from holding those securities was more than enough to offset the losses on price that we were incurring, which would not have been the case if we had been more heavily positioned on the longer end of the yield curve.
Thank you so much. Next question, we have one from Mr. Neil Canlas. What is the difference between the Alpha Opportunity Fund versus the Equity Opportunity Fund? And secondly, another follow-up question, what is the difference between Dynamic versus Balanced Fund?
Okay, so I'll take the first question first. The difference between the Alpha and the Equity Opportunity is the strategy. Now, the Equity Opportunity Fund, while not index-based, is very aware of what the Philippine Stock Exchange Index is doing. But how it differentiates itself is that it's a value strategy. Now, we put a large premium on research, and we have a very strong in-house research team. We never invest in anything that we haven't done our own research or credit work on. And that means looking at all the financials, visiting the companies, talking to the management, talking to the suppliers and the business partners. We do all of that before we invest in something. And by doing that, we're able to determine what we feel based on all of that is the intrinsic value of a stock or a company. What the equity opportunity fund attempts to do is based on those valuations, find something that is undervalued in the market that we think can achieve that type of potential later on. So when you think about it, the Equity Opportunity Fund is somewhat similar to the Philippine Stock Exchange Index in that it holds many of the similar names, but how it tries to differentiate itself is by finding those stocks that we feel are undervalued and have the potential to move to the levels that we see based on our research. So it's a value investing fund. Now, the Alpha Opportunity Fund is a different sort of strategy. What it is a small to mid cap strategy. I believe it's the only strategy or fund of its kind in the Philippines, and it's actually the best performing fund equity fund for 2019 so far, and I believe has been the definitely one of the top three performing funds over the last 3 years as well. Now, for the strategy, what it does is it's a small to mid cap strategy. So, what does that mean? It has no index or Philippine Stock Exchange index names there. What it attempts to do is based on, again, the research that we leverage very highly on. It attempts to identify which stocks will potentially be in the index moving forward, because those are the stocks that become subject to um, the beneficiary of flows. Because index tracking funds, whether offshore or locally, every time the Philippine Stock Exchange rebalances, all they do is they copy it. And when you increase the weight of security, or better yet, if you add a company into the index, all these index tracking strategies will buy that company irrespective of the price, because all they're trying to do is mimic the index. What the Alpha Opportunity Fund attempts to do is identify what could potentially be the next index stock so that it's able to accumulate a position ahead. And if the view plays out correctly, it becomes subject as a beneficiary of all those flows, at which point, after a certain time, because it is now in the index, we take profit on it and look for another name that we think has a similar story. So I think that the strategy has been able to pick index stocks quite well, and we attribute a big part of its recent outperformance over the last few years to that.
Thank you for that, Miguel. And we have a question from Mr. Noel De Luna. How do you value a corporate bond to be part of your portfolio? Is yield more important or the ability of the company to pay?
Actually, we have a quite a robust and rigorous credit review process. As I mentioned, one of the things that we look at are, of course, the financials. Um, Bulk of the companies that issue corporate bonds are listed companies, so their financials are readily available in their filings to the SEC. So we look at that from a quantitative level, and we have an internal scorecard which we map these results against, looking at all the usual types of ratios, of course, but also some that we have discovered for ourselves to be very good metrics for credit strength or weakness. Now, that's just on the quantitative side. As I mentioned, we also assess them on a qualitative side by doing site visits and management consultations, by making sure that what we're seeing in the expansionary plans is consistent with what the management directive is. Because if you can't reconcile the two, then it means that something's a bit off. Now, to answer your main question, what is more important to us, whether it's yield or the ability to pay? It's definitely the ability to pay. Um, I don't think that we've had a credit default in the Philippines since the late 90s in the Asian financial crisis, but we don't like to take the type of risk that we would buy something purely on the basis of yield alone. And that's why we look at all these credits very closely and come up with what we feel is a fair value assessment of that credit spread. Because if for a very strong name, if all they're going to offer is a very tight credit spread, then I might as well just buy a government security, because at least there you have higher liquidity and the ability to trade it more actively. On the other side of that argument, I don't think that we want to buy into a corporate bond that has very little liquidity just on the basis of a very high yield, especially if from a fundamental standpoint, it looks weak. Because you have to consider that when a yield is that high or high enough to be overwhelmingly attractive, it will typically mean that there may be some sort of major risk consideration there.
Thank you. So we have time at least for two more questions. We have one from Mr. Flor Ellie. Do you recommend investing in direct government or corporate bonds or in bond funds? Please discuss advantages.
I think we touched earlier on the what I feel are the advantages to investing in a mutual fund or a unit investment trust fund. And the first is really the accessibility. Um, in order to invest in a bond security, it requires quite a bit of capital. Now, government securities require a little bit less, but specifically for corporate bonds, as I mentioned, you need at least a few 100,000 to just be able to participate. And then you're subject to all the other risks that we highlighted earlier. You're subject to very specific credit risk, concentration risk, liquidity risk, price risk. Now, all these things do not go away when you're invested in a fund, but all of them are mitigated because a fund will always be well diversified, will always have a provision for liquidity, and because you are investing in a batch of pooled funds, you don't need to have that 500,000. You can invest for as low as 1,000 pesos and be able to participate in the same securities and the same strategies as everybody else. Additionally, when you're buying, well, to I guess to put a little bit more clarity on that statement, you would have been down the equivalent of 1.6% at that time. Now, a 1-year T-bill has a duration or interest rate risk sensitivity of 1. So what that means is that it's a 1:1 move. If you bought it at 5 and it moved to 6.6, you were down 1.6%. So if that answers your question, I think that answers maybe your question. No, you would not. If you had held the security before the move higher, you would have been negatively affected as well. But compare that to a 10-year or to a 15-year security with a duration of um, 10. If you had been invested in that, let's say that 15-year security, you had also bought at 5%, and then it moved to 6.6%, then you would not have been down 1.6% on your bond. You would have been down 10.6%, just because the duration or interest rate sensitivity of your bond was 10 instead of 1, which a short-term T-bill would have been. Added to that, on a 1-year T-bill, what's the worst that could happen? If you didn't want to realize the loss and you didn't need the money at the time, you could just wait for it to mature in a few months. But when a 10-year security, it's a bit of a more difficult proposition because you would have had to wait another 10 years.
Thank you, and that's it for our Q&A. Thank you for sending in your questions. And now for everyone's most awaited part, our giveaway. This afternoon, we are giving away FundSmart bundles and the grand prize, a 3,000 peso worth FundSmart investment certificate to be invested in any ATRAM fund. These bundles are exclusive FirstMetroSec travel blankets and exclusive ATRAM shirts. Here's how it goes. Take a screenshot of the next screen, go over to your Facebook wall and post it along with a caption about your favorite part of this afternoon's webinar. We will be choosing 3 lucky winners for the FundSmart bundles, and another winner with the best caption will win the investment certificate. Please be sure to make it public and tag us at First Metro Securities. It's that simple. Our winners will be contacted personally via Facebook or via email. Are you guys ready? So here's the screen. And that's a wrap. Thank you everyone for tuning in. We hope to catch you on Monday, April 15 for our Besties webinar series with Mr. Andoy Beltran, and then again on Wednesday for another FundSmart webinar series with PhilEquity's Miguel Agarao. You can find more details posted on our calendar at www.firstmetrosec.com.ph under Seminars, Promos and Publications, and then Calendar of Seminars. And if you're looking to stay up to date with our latest events, seminars, and everything in between, like, follow, and subscribe to our social media channels flashed on your screens. This has been your host, Cara, and with our speaker for this afternoon, Miguel Liboro. And as always, it's hashtag your future first. Thank you.